There are two kinds of bodies that arrive at Wick's Market Mortuary. The first is already cold. The second still has a pulse, but somebody replaced most of the blood with freshly registered common shares. Tonight's patient is Everbright Digital Holding Limited, ticker EDHL, a six-person Hong Kong marketing company with a metaverse name, almost no year-end cash, a recent reverse split, and an offering large enough to make the old float statistics look like evidence from the wrong corpse. Some traders saw a tiny float and called it a squeeze. The filings saw a company that needed money. Inspector Wick saw the operating table being prepared. Welcome to Wick's Market Mortuary, serving body bag holders since 2026. The market is not just a collection of tickers, it is a crime scene. Tonight, we open the case file on EDHL, patient, Everbright Digital Holding Limited, ticker EDHL. Primary condition, low float trauma followed by severe common share dilution. Working diagnosis, dilution-induced resuscitation. EDHL is a Cayman Islands holding company. Beneath it sits a British Virgin Islands intermediary and the actual Hong Kong operating business, Hong Kong United Metaverse Limited. The operating company provides event planning, social media marketing, website and character design, consulting, and AR or VR elements used in client projects. So let us clear the first rumor off the examination table. EDHL is not a major consumer metaverse network, a large software platform, or a proven artificial intelligence company. It is more accurately described as a small creative and marketing services agency using metaverse, AR, and VR language in its branding. The business is real. It has audited revenue, customers, and completed projects. But finding a headset in the supply closet does not turn a six-person marketing shop into Ready Player One. EDHL began Nasdaq trading on April 17, 2025. The IPO closed 4 days later with 1.5 million shares sold at $4 each, producing about $6 million in gross proceeds. A partial over-allotment later added another 160,000 shares and $640,000 gross. The patient entered the public market freshly admitted. Then gravity took the night shift. By August 29th, EDHL announced a Nasdaq minimum bid price deficiency. The stock had closed below $1 for at least 30 consecutive business days. Only a few months after the IPO, shareholders authorized a consolidation of up to 1 for 50. The board selected 1 for 16, effective February 9, 2026. Approximately 26.66 million pre-split shares became about 1.666 million post-split shares. The stated purpose was to raise the price and maintain the Nasdaq listing. This was not routine housekeeping. It was emergency reconstructive surgery less than 10 months after the IPO. Adjusted for the split, the original $4 IPO price equals about $64 per current share. Recent trading near $4 represented a decline of roughly 94% from that split-adjusted price. The IPO did not age, it decomposed. After the reverse split, EDHL emerged with an unusually small apparent public supply. Chief Executive Leung Chun Yip beneficially owned approximately 1.125 million shares, according to the ownership table. One footnote says 1.152 million, creating a small filing inconsistency. The reported percentage and earlier disclosures align more closely with 1.125 million. We label the inconsistency. We do not quietly choose whichever number makes the chart prettier. Subtracting 1.125 million from approximately 1.666 million outstanding leaves about 541,000 shares outside the controlling holder. That is not an official transfer agent float, but it is a reasonable estimate based on reported ownership. And it explains the violent movement. With only a few 100,000 shares apparently outside the insider position, modest buying pressure could send the ticker sprinting down the hallway wearing nothing but a toe tag. EDHL experienced repeated extreme moves. One reported June move approached 95% without a clearly identified fundamental catalyst. Low float can create scarcity, momentum, and spectacular candles. But low float is not a business model. It is a market mechanic, and market mechanics change when the company opens the supply closet. For fiscal 2025, EDHL reported revenue of approximately $1.862 million. That was down 32.6% from $2.762 million. Gross profit declined to about $1.217 million, although gross margin improved to 65.4%. At first glance, that margin looks healthy. Then we examine the organs underneath it. Selling and marketing expense reached approximately $1.842 million. Administrative expense reached about $2.037 million. The company generated $1.217 million in gross profit, then spent substantially more than that on marketing and administration. Net income reversed from a profit of roughly $379,000 to a loss of approximately $2.246 million. The net loss equaled about 121% of annual revenue. The gross margin survived. The rest of the patient died from the hospital bill. Operating cash flow deteriorated to negative $2.295 million. At December 31st, 2025, EDHL reported $3,167 in cash. Not $3 million, $3,167. There are vending machines with stronger liquidity. Management said it believed working capital would be sufficient for 12 months, but that conclusion relied on support from the controlling shareholder and access to additional debt or equity financing. The current offering did not arrive without warning. The blood panel had already requested a donor. Standalone VR and AR revenue fell from approximately $1.204 million in 2024 to zero in 2025. Consulting and market research revenue also fell to zero. Nearly all 2025 revenue was placed in the broader category called total solutions. Management blamed the decline in pure VR and AR projects on economic uncertainty, cautious customer spending, and the high cost of developing VR services. The company may still use AR or VR inside bundled projects, but the audited categories do not support portraying EDHL as a rapidly expanding pure-play metaverse company. The website advertises virtual streets, shops, concerts, bars, and immersive experiences. The blood work shows standalone VR and AR revenue dropping to zero. The brochure promised virtual worlds. Pathology found a small project-based marketing agency. Inspector Wick trusts the blood work. At year-end, EDHL carried approximately $1.097 million in net intangible assets. Another $1.5 million had been prepaid toward intangible assets. Roughly $620,000 was prepaid for marketing. Together, those balances totaled about $3.22 million, or approximately 68% of total assets. None of that is automatically improper. Software, intangibles, and prepaid services can be legitimate assets, but the concentration deserves scrutiny. This was a 6-employee company generating $1.86 million in annual revenue, burning cash, and finishing the year with barely $3,000 in the bank. 6 employees. Millions tied to software, intangibles, and prepaid marketing, and enough cash to host a very modest office pizza party, assuming nobody ordered extra toppings. The business also depended heavily on a few customers. Its 3 largest represented roughly 43.5% of 2025 revenue combined. EDHL says it has served more than 20 customers since 2021. That does not mean 20 active customers were producing revenue during 2025. The pulse is real. It is also concentrated and fragile. Management concluded that disclosure controls and internal control over financial reporting were not effective at year-end. The identified material weakness involved too few personnel with appropriate United States GAAP and SEC reporting knowledge. The financial statements received an audit opinion, but the auditor did not audit internal control effectiveness because EDHL qualified for a newly public company exemption. An audit opinion is not the same thing as clean internal controls. Ineffective controls are also not proof of fraud. The fair conclusion is that weak controls increase the risk of mistakes, delays, and future corrections. EDHL also used a Form 12B-25 extension to finish its annual filing, then filed within the extension period. No accounting murder weapon was recovered, but the evidence locker could use better inventory controls. Now we reach the central image in this case. EDHL priced a public offering of 4,293,000 ordinary shares at $1.88 each. Expected gross proceeds were approximately $8.07 million before placement agent fees and expenses. West Park Capital served as sole placement agent. The company designated the proceeds for working capital and general corporate purposes. The registration statement became effective on July 23rd. Closing was expected on or about July 28th, subject to customary conditions. At the time of this examination, the offering was priced and highly probable, but formal closing confirmation remained the unresolved item. That wording matters. The SEC did not endorse EDHL or declare it a good investment. The registration statement became effective. The SEC does not issue investment blessing certificates, no matter how often promotional posts attempt that resurrection. The preliminary filing assumed up to approximately 1.927 million shares at $4.41. That was an illustration, not the final deal. When the actual price dropped to $1.88, the share count increased to 4.293 million to raise roughly the intended amount. Using the preliminary share count as final dilution would be examining the wrong body. Before the offering, EDHL had approximately 1,666,275 shares outstanding. The offering adds 4,293,000 newly registered ordinary shares. Assuming the full offering closes as priced, the pro forma total becomes approximately 5,959,275 shares. The new issuance equals about 258% of the previous share count and roughly 72% of the resulting company. Existing shareholders collectively go from owning 100% of EDHL to approximately 28% of whoever wakes up after surgery. This is not theoretical warrant dilution waiting years in the shadows. These are ordinary shares registered for the offering. Upon closing, this is immediate common share dilution. Before the deal, estimated non-controlling supply was roughly 541,000 shares. After adding 4.293 million offering shares, potential non-insider supply rises toward 4.83 million. That is almost 9 times the old estimate. Not every purchaser will immediately sell. Registered supply and active float are not identical. But using the old 541,000 share figure after closing is squeeze analysis performed with an expired specimen. Market capitalization can also be distorted. At $4.21, the old 1.666 million share count suggests a market cap near $7 million. The pro forma count produces roughly $25 million. At the offering price of $1.88, the pro forma valuation is around $11.2 million. Finance sites may display the old number until their databases update. The quote page may still be alive. Its denominator has entered rigor mortis. Before the offering, the chief executive controlled approximately 67.5% of EDHL using the 1.125 million share figure. After a full closing, that stake would fall to roughly 18.9%. The preliminary filing said EDHL would lose controlled company status after issuing more than 583,725 shares. The actual offering is far above that threshold. This financing changes ownership concentration, public supply, market capitalization, and the mechanics behind the old low-float moves. Could EDHL still move violently? Of course. Microcaps can ignore common sense longer than a corpse can ignore a subpoena. But a small float or high borrow fee alone does not establish a conventional short squeeze. A proper squeeze analysis requires current short interest, updated shares outstanding, updated public float, current borrow availability, and confirmed offering status. Several million new registered shares materially weaken the old scarcity thesis. There may still be volatility, momentum, or temporary supply imbalances. Those are not the same as verified crowded short interest. Around the mortuary, We distinguish a squeeze from a muscle spasm. The legitimate positive case is simple. The offering could materially improve liquidity. An $8.07 million gross raise is substantial relative to EDHL's size and near-empty year-end cash balance. Gross margin remained above 65%. The broader total solutions category grew despite the overall revenue decline. The company has real operations, audited revenue, and completed projects. A few meaningful contracts could materially improve results from such a small base. The financing may remove immediate liquidity pressure and provide working capital to stabilize the business. The offering is beneficial to the company's survival. That does not mean it benefits every pre-offering shareholder at every price. A transfusion can save the patient while diluting everybody already in the bloodstream. The documented bear case is heavier. Revenue fell 32.6%. Net loss exceeded annual revenue. Cash burn worsened. Standalone VR and AR revenue fell to zero. Year-end cash was $3,167. The company carried millions in software, intangibles, and prepaid marketing while operating with 6 employees. Management reported ineffective controls and a material weakness. The annual report required an extension. A 1-for-16 reverse split occurred less than 1 year after the IPO, and now EDHL is issuing 4.293 million shares against only 1.666 million previously outstanding. The $1.88 offering price was about 57% below the preliminary $4.41 assumption. Proceeds are broadly designated for working capital and general purposes, not a specific signed acquisition or identified revenue-producing project. The strongest bear argument is not that EDHL has no business. That would be false. The strongest argument is that the real business is too small and financially weak to explain the stock's most extreme moves without low-float mechanics. And the financing changes those mechanics. EDHL is not a corpse with no pulse. It has audited revenue, customers, completed projects, and a functioning Hong Kong business. But it is not the large-scale metaverse platform implied by the most promotional descriptions. The case file shows a 6-person marketing company that entered Nasdaq at $4, fell into bid price non-compliance within months, underwent a 1-for-16 reverse split, re-emerged with an extremely small apparent public supply, experienced violent low-float moves, and then priced more than 4 million new ordinary shares against fewer than 1.7 million previously outstanding. The business needed capital. The offering may provide it. But the tiny float body has received a massive transfusion of registered shares. The patient may survive. It is simply no longer the same patient traders examined before the operating room doors closed. Cause of trauma, declining revenue, severe cash burn, and near-zero liquidity. Aggravating conditions, weak controls, customer concentration, and heavy intangible and prepaid balances. Market complication, obsolete float and market cap data following a massive increase in registered common shares. Final diagnosis, dilution-induced resuscitation following low-float trauma, Inspector Wick disposition, high-risk speculative microcap. Real business, real financial distress, real financing benefit to the company, and very real dilution to the existing body. Place the old float statistics in cold storage. They are no longer fit for identification. This examination is for informational and entertainment purposes only. It is not financial advice. Do your own investigation before entering the crime scene. I am Inspector Wick. The chart may move. The filings do not blink. Until the next body hits the tape, keep the evidence labeled and never mistake a temporary pulse for a clean bill of health.